Hey traders, Tom Gentile here, America's #1 pattern trader and founder of Patterns and Profits. And today I want to talk about something that I think is really important, near and dear to my heart, and that is finding cheap and expensive options. I'm going to show you the worst way to do it, the wrong way to do it, and the right way. And I'll talk about how we spot these and how you can find these, as well as today's cheap and expensive options. So let's go ahead and get started. One of the worst ways to look at option prices to determine whether they're cheap or whether they're expensive is by just looking at the price themselves. All right. Traders might judge a cheap or expensive options on the actual price only. The problem with this is that cheap stocks breed theoretically cheap options, and expensive stocks with long time frames to expiration will have the most expensive options. If that's the way you're pricing options, you need to stay tuned. I'm going to show you a better way. So that's the first way that an option trader will go through and look at options, and that's by static price. Then option traders, if you make it long enough, you start understanding that there's more to it than price. There's time to expiration. There's volatility. Implied volatility is a great way to help judge whether an option is cheap or expensive. But guess what? If all you're looking at is current implied volatility, you're doing the wrong thing. All right. And the reason why is because just because today's implied volatility might be a high number or a low number doesn't mean that that option tied to that asset is cheap or expensive. And so, you're not reflecting on where it's been in the past, because if you're just looking at high implied or low implied volatility, then you're going to find that most quiet stocks, you're going to think they're having a cheap rating when they may not be, or explosive stocks might have an expensive rating when they may not be expensive either. What I want you to focus on is what I call IV range. IV range takes a year minimum of implied volatility rankings. We actually create a chart off of implied volatility rankings. And what we're able to do is get a 52-week high of that chart, a 52-week low of that chart, and where we are currently. And if we're at the 52-week low, now we can consider something cheap. Or if the IV is at a 52-week high, we can look at that option as being expensive. Now, I typically like to look at near money options, and I can look at 30, 60, 90, 180 days to expiration. But the 30-day options I favor because they have the most volume and the bid-ask spreads are the thinnest. So therefore, it's more of a reflection of current IV when I'm trying to project whether something's cheap or expensive. Here's an example of a cheap implied volatility option. This is ETHA. ETHA, and as of this recording, if you take a look at, not looking at the price, we see the prices come down and it's kind of stabilized. The red line is the implied volatility. Notice where the low is. The lows are here in both at the beginning of the year. The high came in February as Ethereum and ETHA was dropping really hard. But since then, Ethereum and ETHA have consolidated, started moving a little bit higher, and the volatility has been sucked right out. And it's now trading at new lows as of this video. So that's what I consider cheap options. The implied volatility on ETHA is as low as it's been in the last year. In fact, here's how we're ranking them using the Hub platform. You can see the cheap IV range today is ETHA. TMF is on the cheap side. Sezzle, Ascend Pharmaceutical, and Pitney Bowes. What do they all have in common? Look at their IVs marked for today. Look at the 1-year range. It's the same. It's telling me that these IVs are as low as they've been in a year, and that means that these options are cheap compared to where they've been in the last year. Let's take a look at expensive. Here's an example of an expensive stock that has expensive options, Micron Tech. Micron, although the price has been moving up and is now sitting on new highs around 800, the implied volatility has been up and down and up and down and up and down. And it's created these, it looks like higher lows and higher highs. But the lows in the last year have been down here around 45. This is the left-hand side, implied volatility. Right-hand side is the stock price. Left-hand side shows IV down here near 40. The high is close to 90. So it's safe to say the implied volatility has more than doubled. The time premium is more than doubled when you look at 1 year ago versus today. And today we're sitting on the most expensive IV that we've been in all year. Expensive option. Here's the top 5 when we rank those using the Hub platform. Micron at the top, Intel second, Qualcomm third, Tower Semi was 4th, and Cisco was 5th. 4 of these 5 stocks are all semiconductors. Tells me the entire industry, the entire sector is a glutton of expensive options. As you can see, the ranking is at 100, which basically means they're all sitting on their 1-year highs. IV of today is equal of the IV range high, and that is the case in all 5 of these options. So don't price your cheap or expensive options merely by price or even IV. I want you to price them like a weatherman. All right, look at pattern highs, look at pattern lows, and where we are currently. And of course, I like to be a buyer of cheap options premium, and I like to be a seller of expensive option premium. Hope you enjoyed the video, and I'll see you on the next one.